higher?
Well, this is a matter that quite a few academic and business economists are opining about. I should say that it is not something that the FOMC is currently considering or that we have on our agenda. The reason that this idea is getting so much attention is one that I think it's important for the public to understand. And that is, the evidence suggests that not just in the United States, but globally, and I'd say largely due to slow productivity growth, which we've seen not just here, but in many parts of the world, as well as demographics, aging populations, it looks like, in some sense, the strength of underlying aggregate demand is weaker than it's been historically. Or let's say there is a lot of intended savings relative to investment, and that's pushed down the level of the equilibrium real interest rate. And in a world where equilibrium level of real interest rates are low, that's something that tends to mean the average level of short-term interest rates will be low. Well, with higher inflation, you would be raising the average level of short-term interest rates point for point. So it's a reason, namely, to give more scope for monetary policy to address adverse shocks. That's something that people argue could be accomplished with a higher level of inflation. But I guess I would simply say that in analyzing that, which I hope there will be research looking at it, we need to consider not only the benefits, but also the costs of a higher level of inflation. And for a variety of reasons, higher inflation may distort price signals, may lead to more variable and volatile inflation, and impose costs on people who have a variety of reasons to take it into account in planning. So it's not a straightforward decision. It's something the committee considered carefully years ago when we adopted 2%, but it would also need a serious reconsideration of costs and benefits.